And they told you the deal, right? Okay.
I think we have started. I'm going to go ahead and introduce myself.
I am monitoring it here.
Okay.
There you
Okay, awesome. Good morning, everybody. My name is Lila Quintiliani, and I am one of two finance and benefit counselors at Military Officers Association of America. I'm going to go ahead to the next slide. In case you are not familiar with our organization, we are a nonprofit, nonpartisan legislative advocacy organization. We do have 10 registered lobbyists who go up to Capitol Hill to fight for your pay and benefits. I am not one of the lobbyists, but that is the main focus of our organization. And here are some of the issues that we've had success with in the past, including military compensation, your raises each year, and having veteran health care, making sure TRICARE fees don't get hiked, concurrent receipt, and repeal of the widow's tax. Moving on to the next slide. This is just a disclaimer. We are not a financial firm. I don't sell any products or services, and I don't do personal financial planning for anyone. And I always suggest that people consult a professional when you have legal or tax or financial personal finance questions. I'm going to discuss today, I'm on the next slide, some concepts of investing for the long haul. Next slide. Saving versus investing. A lot of people get confused about the difference between this. I like to call it your tactical plan versus your strategic financial plan. And the main difference between saving and investing is really the when and the where. When are you going to be needing that money, and where are you going to be putting it? Next slide. So your tactical financial plan is your day-to-day business operations, your cash flow in, your money going out to your bills and your expenses. Hopefully you have some sort of spending plan or budget, and you're saving really for near and medium terms. You're looking at the next 5 years or sooner. You're planning for a vacation. You're planning for a down payment on a car you're going to buy next year. But your strategic plan is really saving for the long haul, because you could look at retirement as basically 40 years of unemployment. And just having income and savings alone isn't going to cut it, because you're going to need significant growth. And you have to put your money to work by investing it. Next slide. And really the key to building wealth is ownership. Not just having stuff, but having things that are going to increase in value or provide a return over time. Things like your retirement plan, the TSP or a 401k, stocks, bonds, and real estate. And the risks, there are risks involved in investing. There's market risk, because markets go up and down. There's market timing, and that's us putting our money in the market and then taking it out if we get spooked by news, that people on the news that are always talking about something that's going on in the world, and it frightens us and we pull our money out. Investor psychology and behavior. I'm a big fan of behavioral economics. I think it's very interesting to understand why we do the things that we do, why we are afraid to invest, why we can't save for retirement, even though that's our future self. And then there's expenses, because investing, there are expenses involved, and I'll talk about that in a second. But all of these risks are far outweighed by the risks of not investing, because we have taxes and inflation to consider. And then the worst thing is having insufficient retirement income, outliving your retirement income. Next slide, please. And this is just an illustration of why you need to invest. This graph is comparing market returns over a 50-year period from 1970 to 2020. And you can see that stocks had a 10.7% return over that time. But if you consider taxes and inflation, it's only a 4.8% return. Bonds had a 7% return over that time frame. But if you take into account taxes and inflation, that goes down to 0.1%. And then cash would have had a 4.6% return over that time. But if you take into account taxes and inflation, there's actually a negative return on cash. And this is not to say you shouldn't have any cash, but if you only have cash, if you only just stick your money in the bank, you're not going to keep up with taxes and inflation. So that's why you need to be doing both. You need to have your tactical and your strategic financial plan. Next slide, please. The next slide here shows the cost of timing the market. And what it is showing is a value of $10,000. If you had invested it in the market in January of 2003 and then left it in the market for 20 years. And this time frame did include some huge dips in the market, like the .com bust. One of the biggest drops came during COVID. All of this is included in that 20-year time frame. But if you had just left your $10,000 and not listened to the news and pulled it out or done anything with it, after that 20-year period, you would have had $64,844 in your account. If you had, that's the first bar. The second bar is just missing 10 of the best days out of a 20-year period. If you had gotten spooked and pulled your money out and missed 10 of the best days, then you would have had basically half as much. You would have only had $29,708. And as you go down this graph, you can see that after, if you miss essentially a little over 30 days out of a 20-year period of time, then you've lost money, actually. So what this is saying, next slide, is market timing is a losing proposition. In order to be successful, you have to be right twice. You would have to buy at exactly the correct time and sell at exactly the correct time. And that's pretty much impossible to do. So keep it simple. Investing doesn't have to involve keeping up with all those Reddit threads that tell you to buy different, crypto or other types of investments. You don't have to do anything more, chase returns and the latest fads. You could just keep it simple, get in, stay in. The right time to invest is always now. Next slide, please. I'm sorry, I neglected to tell the home audience to advance. So we need to advance one more slide.
It was buffering for a minute.
Oh, okay.
And while it was buffering, it's still on the cost of timing the market slide.
Okay, so now we should advance. I see now it's on strategies. Great. What do I do now? Which is what I'm going to discuss next. Next slide, please. And the first strategy I'd like to discuss is just having objectives for your money. Set goals for your money, because that's going to tell you what type of vehicle it should be in, meaning what type of investment. If you're saving for vacation in December, then you're not putting money into your 401k. You're also not putting money into the market if you need to be spending it within the next 5 or so years. If you're counting on that money, it needs to be somewhere that is going to be safe and liquid. And and knowing what you're going to do with your money is going to tell you where you need to put it and the type of investment you need to put it in. Next slide, please. And you're going to want to...
right there, they have the strategies right now, so have them go to the next slide probably.
Yes. It should be understand what you're investing in. And I'm going to talk at length about that in a few minutes. And then the next slide is pay attention to fees.
Now they're going to define your dollars objective.
Yeah, I think we're a few slides behind. You should be on a slide that says pay attention to fees. And this is a slide from the Security and Exchange Commission, Office of Investor Education and Advocacy. And this is basically showing how important fees are. You want to look at investments that have low fees. This graph is showing how much of your investment return gets lost to fees. If you had a 1% fee on an investment, which wouldn't be that unusual, in 20 years, that would add up to almost $28,000 of fees on a $100,000 investment. So basically almost a third of your investment eaten by fees. And then if you were to invest, there's like an opportunity cost, because also that $28,000 that you're not investing would have generated an additional $12,000. So fees are very important to look at. Next slide. There is a way you can analyze and compare the cost of owning funds. FINRA, the Financial Industry Regulatory Authority, has a website where you can see compare fees on more than 30,000 mutual funds and exchange traded funds. So you could go there. Next slide, please. If you have funds invested in, if you have an account at TSP, you can, it is a little bit tricky to play around with their website, but there is a way you can compare the different fees on the funds. For example, I was comparing the G fund, the C fund, and the I fund. The C fund is equivalent to the S&P 500. And if you look, it says the expense ratio is 0.036%. And that translates to 36 cents for every $1,000 invested. $1,000 invested. So that is the cost of investing in that fund, and it's pretty low. Next slide, please. So you could consider.
Say next slide again. They are now looking at the analyze and compare cost of owning funds. So
Okay, so they need to advance to the. Next slide was the TSP slide, where I compared the cost of owning the TSP. And then I'm now on consider an index fund. And an index fund is just a portfolio of stocks or bonds that are trying to mirror the composition of a financial market index. And one you hear a lot, it's the C fund, and the TSP is the S&P 500. S&P stands for Standard & Poor, launched back in 1957, and it's the 500 top U.S. companies that are publicly traded. And this is a good low-cost way to invest in the market. It has lower expenses than an actively managed fund because it's just mirroring what's in that particular financial market. And you can see here that the average actively managed mutual fund charges 0.49% in annual fees versus the average index fund charges 0.06% in annual fees. So they're a lot lower. And as we saw, fees can eat up a lot of your investment. And if you remember, the TSP was even lower. The C fund there was 0.036. Just some of the current top holdings in the S&P are things like Apple, Microsoft, Amazon, Google, and Tesla. Next slide, please. So these are just a couple of quotes one is from Warren Buffett. Hopefully you know who he is. He's one of the greatest active investors of all time. And he's instructed the trustees of his will that when he dies, 90% of his wealth will go into the S&P 500 for his wife. And then this quote from John Bogle, the founder of Vanguard, he says, "Don't look for the needle in the haystack, just buy the haystack. Don't try to find this perfect stock that someone on this Reddit thread or on TikTok, which is unfortunately the new financial source of advice for most folks now, I've heard. Don't try to find this stock. Just buy everything, right? And then you need to understand your contribution versus your portfolio allocation. Contribution is just where your money's going when it goes into the account, and the portfolio allocation is how it's structured, how your investments are structured, whether you have them in stocks, bonds, or cash. Next slide, please. Next slide, please. I think you guys are behind.
Yep.
Okay, and you're going to periodically rebalance because what you want your allocation to be is going to change over time. Next slide, please. And an easy way to do this, if you're not into messing around with your stocks and looking at them on a daily basis, is to do something like the life cycle fund. Most companies have something called like this, either life cycle or a target retirement fund, something like that. And I'm just showing you here what they're doing for you behind the scenes. The folks that are running these funds are changing your allocation so that when you're younger, like 2070 is for people just coming into the military, for example, that are not retiring until 40 something years from now. They're going to be mostly invested in stock index funds like the C fund, that S&P 500, or the S&I fund. Those are all index funds. And then as time goes on, those funds are going to adjust so that at the very end one, that L income fund is when people are retired and actually taking money, withdrawing money to live on. Most of their portfolio is going to be invested in the G fund, which is a kind of a cash equivalent. You can't lose your principal in the G fund, but it doesn't have a lot of growth. But when you're retired, you're adjusting your portfolio so that you are having less exposure to those kind of stock funds. So you can either do all this yourself. You could even look online and see what these funds look like and try to mimic it yourself and then adjust it periodically. Or you could just stick it in one of these life cycle funds and set it and forget it kind of thing. Next slide, please. And then the next slide after that, I'm going to talk about retirement accounts and tax issues. Just very quickly, a traditional retirement account, like the traditional TSP, you're going to pay taxes on that later. It's helping you on your taxes now because you're making a tax deductible contribution. And your investments are going to grow tax deferred, but later you'll pay taxes on it. Next slide, please. With a Roth retirement account, you're paying taxes now, but when you go to withdraw that money, you will not pay any taxes on it. Next slide, please. Just to show you how this plays out on our website, on the MOA website, moa.org, we have some free calculators. Here's one that's just showing what happens if you were to invest. The red is traditional, the blue is Roth. If you had a Roth account and you were 40 years old, you're putting $10,000 in it, you're letting it grow for 25 years here, you end up with roughly the same amount. And this is assuming a 7% return and actually a lower tax rate in retirement. So you have a little bit more in the Roth, but they're essentially the same. But if you probably, the people here may not be able to see, there is a little checkbox that says invest annual tax savings generated by a traditional account. Next slide, please. If you uncheck that box, which would mean figuring out how much you're saving in tax each year and investing that amount, which I don't meet many people who do that. This shows why I'm a huge fan of Roth accounts, because Roth will win. If you don't invest those tax savings that you're having in the present, then you're always going to come out ahead with the Roth. Why do I say all this? Because next slide, please. Here's why you might want to think about tax considerations. I talked to lots and lots of retired military officers, and most of them are unaware of Medicare and TRICARE for life. You actually age out of TRICARE at age 65, and you have to pay for Medicare. Medicare Part A is free. Medicare Part B has a premium. If you can see in red, your Part B premiums are based on your last recorded tax return, and there are surcharges based on income. So they look at your modified adjusted gross income from 2 years prior to you turning 65. And I'm not going to go into all these things here. I left the information in there for you to look at. But next slide, and then the next slide, please. You can see what the premiums are this year. One more, yes. And you can see, and I meet many officers who get hit with, it's called IRMA, the income related monthly adjustment amount that a lot of people get hit with. And how you can avoid this is by doing good tax planning and making sure that you have options like your Roth account. So you could take a distribution from your Roth. It would not impact your modified adjusted gross income and will not make you incur the IRMA. Next slide, please. So speaking of different ways to, I got a message that's telling me it's time for my exercises. I think that's from, I'm assuming that's not a comment. The defined contribution plan, this is your main way to save for retirement. This is your TSP, your 401k. Sometimes it's called 403b or 457 if you're in education or a nonprofit. This is the main way people save for retirement. That's because it has a very high contribution limit. You can put up to $23,500 in it this year, and you can put in more amounts if you're over 50. And you could choose between Roth and traditional. You can choose a mix of both. You just can't go over that total contribution limit. Next slide, please. You're going to definitely want to understand how your 401k or your TSP works. And if there's a match, how much is the match? How long do you have to work for your employer to get that, to keep what the employer matches? And you're going to want to understand your investment options. And know, especially if there's a default option, because if you're just auto-enrolled in it and you don't know what you're enrolled in, then you need to find out. Next slide, please. Another way that folks can save, and some people don't realize that they're eligible to save, is you can have an employer-sponsored account like a 401k or the TSP, and you can also have an IRA, an individual retirement account. And these can also be either traditional or Roth. These are the second choice for retirement savings because they have a lower contribution limit. Again, it has to be earned income. I have a lot of retirees that are totally retired, not working. You have to have earned income to do this. The exception is if you're working and your spouse isn't, your spouse can have one. There are income limitations on this. And high earners might need to consider doing something called a backdoor Roth, which I don't have time to go in, but I know my contact information is out there and I have an article I wrote on it and I can send it to you if you're interested. I just put the contribution limits, next slide please, up here for you, and just to show you a lot of people, once they get out of the military and their income isn't tax sheltered, like there's not all, BAH and all those other things that you don't pay taxes on, they find that they are suddenly not eligible to contribute to a Roth IRA. And so then they might have to consider something called a backdoor Roth. Understanding the thrift savings plan. Oh, next slide, please. Thank you for reminding me. What can you do with a thrift savings plan when you leave the military? You can keep it in the TSP. You don't have to take it out. You could roll it into your future employer's plan to consolidate it. You could also roll it into an IRA. You're going to want to match the tax treatments on these. So if you have a traditional TSP, it should go into a traditional IRA or a traditional 401k. Because if you don't do that, if you try to convert it, you're going to pay taxes on it. You could also pull it out and use it, that's a last choice always, because you will be paying early withdrawal penalty and tax on it. If you do want to keep, some people do a mix. They want to keep their TSP account open, but they also want to roll some of it out. You can do that. You just always need to keep $200 in your TSP account to keep it active, or they'll close it. And that is the one time I definitely advise putting it in the G fund, because the G fund can't lose money. Next slide, please. I don't talk much about insurance, but I do believe in having insurance to cover financial risk that you cannot afford to take on. I am not really a fan of using insurance to manage money. A lot of products are sold to folks that are mixes, and they can be very complicated, and make sure you understand what you're getting into and the costs involved, because a lot of insurance products have high costs. Next slide, please. One insurance product that I definitely recommend to folks who have any kinds of, not just situations like this where you have significant savings like a lot of military folks do. You own a home, you have a trampoline, you have a dog breed that might bite somebody. One that's not on here that I am, a person that has this myself. I have teenage drivers. So if you have any of these kind of things in your life, then you might want to consider an umbrella policy. This is a type of personal liability insurance that covers claims in excess of your regular homeowners or auto policy coverage. So even if you have very high limits on your auto insurance, which I do living in this area, I have really, really high limits set on my auto insurance. But even then, they could be easily exhausted by, somebody, my teenager, knocking on wood here, getting into an accident. There could be all kinds of you could, if you were to hit a surgeon and he breaks his arms and then he sues you because he can't, do his work, there could be property damage, there could be all kinds of things. And that can be covered by an umbrella policy, which is usually only a few $100s for $1 million of coverage. So it's worth asking your insurer if they have this type of policy. Next slide, please. I'm not really going to go too much into additional information and resources, but I did put them on there for you. Next slide. I always suggest looking for a fee-only financial planner and interviewing several before you pick one. Next slide, please. You want to check out your investment professional. Unfortunately, there's not one database where you can check people out, because people are registered and regulated by all different types of bodies. But you can check out on investor.gov, which is the SEC website. See if someone that you're thinking of investing with is going to be on that site. Next slide. If they're a broker, they could also be on the FINRA website, broker check. And then a lot of them are state regulated, so you might have to just literally Google their name and look and see if they have any kinds of actions against them, because you want to, you always want to check out before you give someone your money to invest. If you have, next slide, please. If you have any questions, you can email me at beninfo@moa.org. And just make sure that you put NNOA in there so I know where the question is coming from. But I'm happy to answer those questions if you don't have any right now. And with that, I conclude my presentation. I don't know if, I think we're going to go on to your presentation before we stop for questions. I'll let Mike, I'm going to move the camera and everything over and not dump my coffee.
Mike, I would say hold up before you start your presentation so we can make sure we clear this off and get your stack.
Here, can you?
Yeah,
okay, let me get your.
Just wait a moment while we get this up.
Yeah, I think I'm trying to look at.
Nope. Looks like it's up.
They haven't got your slides up.
Not yet.
A couple minutes.
Just wait a second until we get the slides up so you can follow along.
Michael is still buffering. He's going to cue you when they get caught up now.
All right.
And we'll keep going.
Okay, cool.
All right, so hang on one second.
Sure.
It's interesting when you think of all the doggone technical stuff. You never worry about it. How does TV work? You just turn it on and it goes.
Let's say if you could go back in time, would you change anything? I don't know how anything works, so I don't think I could.
Magic. So Art's going to give you the cue. And you can start and they got your slides already queued up.
Excellent.
Okay, Mike.
All right, looks like we are ready to go. Good morning, everyone. Thank you for joining us. My name is Michael Tita. Next slide, please. I represent Navy Federal Investment Services. I consider it an honor and a privilege to be talking with you today this morning. Next slide, please. Sometimes people ask, well, what is Navy Federal Investment Services? And it can be a little complicated. Navy Federal Investment Services is a subsidiary of Navy Federal Financial Group, which itself is a wholly owned subsidiary of Navy Federal Credit Union. When people ask me, where do I work? I just say Navy Federal, just to avoid a lengthy conversation about the legalities. But basically, the government says you have to keep deposits and investments separate. So in this room, when I'm talking, we're talking about typically investments. Next slide, please. Okay, so this is just a broad overview of the topics we'll be discussing today. And I'm going to come from it from a point of view of, if I was sitting down in a room with a service member or a federal government employee or something like that, depending on where you are in your journey, we would typically cover some of these topics in more depth or in less depth, right? So for example, if I was speaking to somebody who was in their early to mid 20s, just getting started out, it wouldn't make a whole lot of sense to dive into deep retirement planning. And conversely, if I had a 55-year-old in front of me, I wouldn't waste time getting into budgeting and saving unless it was specifically asked for. So I've been led to believe that this is a sophisticated audience. So I'm going to keep it high level and hopefully spend a little more time and talk a little more in depth about some of the topics that might be more pertinent to this crowd. We're going to get started by talking about the very basics, right? The building blocks of creating a sound financial strategy, understanding your financial position, cash flow with budgeting, how to manage your debts that you have. And then moving past that, how do we move from, understanding our position to creating something long-term sustainable? So we need to start by creating some sort of emergency reserve, right? Saving money. How do we save money? What type of account do we save money in, et cetera? And then hopefully we get to a point where we can, invest for the more long-term and grow our money in real terms and build wealth for ourselves. But also it's super important to understand the risks that you face and having a plan to protect those risks. So with that, we'll get started. Next slide, please. And you can just go to the next slide. Okay, so no matter where you are in life, the first most important thing is you have to understand your financial position. Okay, so when I'm meeting with somebody for the first time, I will spend the first 15 minutes to half an hour, depending on their situation, trying to understand their financial position, because I can't help them unless I understand that myself. So what does that mean? What are your assets? Where are they? What type of assets are they? What are your debts? What kind of debts are they? Income sources, expenses. These are kind of like the four main groups of just getting to know your basic financial position. From there, what do you want to do? What are your goals? You have to identify your goals, and then you prioritize your goals. I'm sure we all wish we could be doing everything, but most people have limited resources to allocate to all of these goals. And so we're going to identify and then prioritize those goals. Okay. The budgeting aspect, if someone's just getting started out, we want to make sure that we're not going into the red, avoiding, like credit card debt or something like that. But even for like retirees, right? Having an understanding of, well, how much can we spend every month and feel pretty confident in doing so without running out of money. So yeah, with those older members, we might not be going into, I spend $100 on utilities and $200 on groceries and all that, but having a general idea of where your money is going, so that this way we can create a strategy for you so that you don't run out. That's the basic idea. And then, an emergency fund or, savings, that's something everyone needs pretty much always, right? The idea being that sometimes things in life just go wrong. And if you need a lot of money, like the water heater broke or your car broke down or something like that, the last thing you want to do is not have any cash, so you'd have to, take on debt, or B, dip into some of those investments that Lila was talking about to pay those bills. So we need to have a good foundation of savings and emergency funds that's safe and available to us so that we have liquidity when we need it. Next slide, please. Understanding debt. Now, I'm no debt expert. The credit union definitely be better acquainted with that. But at a basic level, what type of debt is it, right? There's a big difference between, a 30-year mortgage at 3% and your credit card at 22%, right? One of those is a high priority debt that we need to pay off as soon as possible. The other one, people would kill us these days just to get, because it's so good. And then you have things in between like car loans and student loans, and those can vary a lot. And there's usually some sort of trade-off, right? A lot of questions I get asked is, well, should I pay this debt off or not? And a lot of times that's going to depend on the interest rate on that debt and how that compares with your opportunity cost of doing something different than paying down that debt. So it just depends. Next slide, please. Credit score most often comes up with our younger members who are thinking about purchasing a home for the first time or some major purchase, sometimes a business loan. It's helpful to know how a credit score is calculated, what factors play into your credit score. And so you can kind of preempt the decision to take out a loan by doing things that would improve that score. Okay, so payment history, utilization of credit, mix of credit. These are all things, sometimes they're not intuitive, right? Like I know when I was growing up, I was told you have to have more than one credit card, which to me made no sense at all. But apparently the credit agencies love that, right? They love different sources of credit. So sometimes things like that members aren't aware of, or service members aren't aware of, and just want them to be aware so that they can have as high a score as they possibly can and get the loan that they want. Next slide, please. Next slide. So one of the hardest things to get across to folks is how interest works, and specifically how compound interest works. So on this slide, we have a very simple interest example, but it's useful as a starting point because in this example, the 10,000 is growing by 6%, so 10,600. And then you ask somebody, well, what happens if that earns 6%, and then that earns 6%, and so on, ad infinitum. And that's the basic building blocks of understanding compound interest, which our brains are not very good at really understanding. And when we talk about investments later, that's the key to the whole thing, right? Time and interest on interest, and that's where you get the exponential growth that, again, our brains aren't really good at comprehending. So next slide, please. We'll talk about kind of compound interest. So that same 10,000 that we earned 6% after 1 year, okay, we have 10,600. well, what if we earn 6% for 50 years? Well, now that turned into $184,000. Okay, so if you were to graph that, that would be parabola, and that is what we call exponential growth. It's one of the most powerful forces that we have. It's why we encourage our members to start investing so early, because they have that time. But note that this applies to pretty much everybody, right? Even if you are retired or considering retirement, if you're a 65-year-old person, you need to plan to live at least 20 to 30 years, right? Now, you might not live 30 years, but you need to plan to live that long, because if you do, and you didn't plan to live that long, you might run out of money, right? So compound interest is affecting everybody at all stages of life, and it's nice to have an idea of how it works. You don't have to memorize these numbers or anything. Next slide, please. One of my favorites is just the rule of 72. This is just a quick and kind of dirty way to find out how long it would take you to double your money at a given interest rate. So if you think bank interest on a CD is 4% maybe. So you just do 72 divided by 4, and that's 18 years. It's early, but 18 years to double your money. It's not bad. Checking account, basically earning 0. That's going to take you, multiple lifetimes to double your money. And with a more market rate of return, you expect to double your money every 6 to 10 years, depending on the market that you're in. So doubling your money every 6 years is obviously a lot better. So once we have those needs taken care of with our savings, we'd love to be able to put whatever else we have into something that's going to double every 6 years, rather than waiting 2 decades. So next slide, please. So it's always important to have a plan for contingencies in your life, right? That's why we're talking about this in the savings section, because everybody is subject to unexpected changes in your situation. And, military, you guys even more so, right? So PCS, sudden deployments, all of these factors, they either will happen or they have happened. And it's just good to have a plan for that. And then when your situation does change, maybe you change jobs or something like that on the private sector, it's just important to review your situation again and see how the change has impacted you. Because it might be the case where you have to change something in that to account for the changes in your life. And so that's my job, is to help people plan. Next slide, please. All right, this is where I wanted to spend the bulk of today, because this is where we start talking about moving past those foundational steps, if you think of a pyramid, and into some of the more fun stuff. So growing our money, and how do we do that, and what's the best way to do that depending on what stage of life we're in or our situation in general. So next slide, we're going to talk a little bit about asset allocation. So asset allocation in this context means the mix of risky assets and safe assets, okay? Now, if you're not sure which is which, because you'll see on there, stocks are high risk, high reward, and bonds are low risk, low reward. That's a good rule of thumb, but if it went up in 2008, it's a safe asset. If it went down in 2008, it's a risky asset. Now, there are lots of bonds out there. Some of them are safe. Most of them are safe. Some of them are not safe at all. So it's a mix between risky assets. Stocks almost always are in that basket. Bonds sometimes are, and safe assets. Now, the mix of those two we call asset allocation, and it's by far the most important decision you will make. So in your thrift savings plan, for example, we'll just keep it simple. We have a C fund, that's our risky fund, that's our stock fund. And we have our F fund, that's our safe fund. Safe meaning it goes up when things get really bad, right? And so if you have both of them, you can be better protected during downturns. Now, whether you should or to what extent you need to protect your risky positions, that depends on you, right? So if you're in your 20s, 30s, 40s, maybe even early 50s, basically if you're 10 years or more out from retirement, unless the market is keeping you up at night and you're losing your mental health, there's no objective reason why you would need to include safe assets unless you really wanted to. Okay, so you can just go all into the C fund and never check it, or check it every year or something like that. But as you approach retirement, things change because the reason why you can be so aggressive when you're young is because if things go bad, well, you just kind of hold on, you're along for the ride, right? You're not selling your thrift savings plan to generate cash to live your life. In retirement, the equation changes, right? Now, you're not working anymore, and you may need income from your assets like thrift savings just to meet the shortfall that typically exists between your pension income, which is for most people just Social Security. I understand if you're retired military, you might have a pension that's super powerful. We'll talk about that a little later. But for most folks, Social Security is not enough to meet their spending needs. So that gap that exists has to come from savings. And so since you're selling something to generate income, you are more subject to the ups and downs of the market, the volatility of the market. And how do we reduce the volatility? We include safe assets in our portfolio. So typically a retiree's portfolio is going to look a lot different than someone my age, for example, right? Because I'm not selling anything to pay for groceries. In 30 years, I will be, okay? Diversification is also really important because you can have a 50-50 mix of safe and risky assets, but if it's one risky asset and one safe asset, like one stock and one bond, yeah, you have a moderate asset allocation, but if one of those things goes down, you're out of luck. And so by building a diversified portfolio, you change the meaning of risk itself. When you have the C fund and the F fund, the risk to you isn't you losing all your money. That's not a realistic risk. The risk is volatility, right? The ups and the downs. So by just having a diversified portfolio of these funds in your thrift savings or anywhere else, you eliminate that risk of losing it all, okay? So next slide, please. So most people don't want to work forever. And so a great way to not work forever is to invest in your qualified plan. And I won't go into this so much because Lila covered a lot of it, but the reason you invest in a qualified plan first, usually, is twofold. One is the higher contribution limits, right? $23,500 if you're under 50, $31,000 ballpark if you're over 50. Way higher than like individual retirement accounts. Whether you do Roth or traditional, you're getting some sort of tax benefit for doing that. You can make trades in the account because it's tax deferred, so nothing gets paid until it comes out in a traditional account, for example. And all of these plans are very similar, 401k, 403b, TSP. These are all qualified plans that are defined contribution plans where you take on the investment risk. And the only difference is who's offering it, right? So thrift savings is just very specific to military and government. 457, that depends where you are. That can be a qualified plan. It could also be a non-qualified plan. But these are all retirement accounts where you're usually saving money for down the road. You don't want to touch this. And I'm sure we'll get a question later about what's the best way to save if budget's tight. This is one of the best ways. Okay. So next slide, please. And one of the other great parts about using a qualified plan or a retirement account is typically people will put a percent of your paycheck in there. And so what you're doing is, whether you know it or not, you're doing something called dollar cost averaging. So in this example, if you're putting $100 a month into a fund or anything, depending on the price of that investment, you're buying more shares or less shares. So if price goes down, you're buying more shares. Price goes up, you're buying less shares. And it's a great way to kind of average your cost into the market, not have to worry about timing the market. We heard from Lila how impossible that is, especially in the short term. And it takes a lot of the emotion out. So I find that this works not only with contributions, but also in retirement for distribution, right? So if you don't know, at a certain age, the government makes you start taking money out of your traditional qualified plans or your IRAs, the required minimum distribution. So even if you never think you're going to need the money, the government makes you start taking it anyway. So eventually you will have to take something out of these plans. And the question always is, well, how should I do that? You have options. You can take it once a year in like one big lump sum, or you can spread it out. And while both are viable options, I find that the dollar cost averaging on the way out to be usually the best one, because the last thing you want to feel when you're retired is regret that you picked the wrong day to take out your money, right? You want to be doing other things, grandkids, golfing, whatever, traveling. You don't want to worry that you picked the bad day because, the Fed chair said something that day, something totally out of your control. Okay, so DCA, dollar cost averaging on the way out, is also very viable, and I find it leads to anecdotally, it leads to the best outcomes. Next slide, please. Okay. Next slide. So with retirement planning in particular, what we're looking to do is basically take two numbers. How much are we spending? How much are we earning? And by earning, I mean what's guaranteed. Social Security, your pension, those are all what I'd consider guaranteed income. And is there a gap there? Now, if there's no gap, if you're making more money from your guaranteed income than you're spending, good for you. You pretty much don't need anything. For most folks, that's not the case, especially in this area, because expenses are so high. So there usually will be a gap. And what we're trying to calculate using computers is how likely is your savings able to basically meet that gap over a long period of time, right? So as a percentage, how much are you taking out per year? Is that sustainable in the long run? And then you can kind of stress test for various things that go wrong, like a long-term care event or something like that. This is where asset allocation becomes really important. That's why I talked about it before, and it's by far the most important decision you will make in retirement is that asset allocation, if you do need your savings to bridge that gap, which most people do. Next slide, please. Insurance is almost always important. It's a very broad term. When you're younger, you need to protect against lots of things, but one of the things is lost income if something happens to you, right? So if you're under the age of 40, your biggest asset is probably nothing you own yet. It's probably your future earnings. And so life insurance is a great way to protect your family or loved ones or people who depend on you from the loss of that. God forbid something should happen to you. As you get older, or this also could apply when you're younger, typically when you're younger, you don't have a ton of free cash flow. So term life insurance is a great low cost way of protecting your family. As the name implies, term insurance has a term. It ends someday. Sometime you might choose to use something that's more permanent life insurance, with whole life being an example. And this would just never go away, basically. It's more expensive, but there are perks and benefits to having a policy, but it's permanent, right? It doesn't expire at all. And then your needs will change over time. That 35-year-old term insurance might be the single most important thing for his family. When they're 65, it might change. It might be long-term care insurance, right? Maybe you don't want to be a burden on your children if something like a dementia, Alzheimer's situation that's not covered by Medicare or something like that, and it's extremely expensive. So insurance is always there, and it just changes a lot as you get older. Next slide, please. And then the most fun one, estate planning. Estate planning covers the transfer of assets upon death and who's in charge of various things in your life while you're alive, but maybe not capable of making decisions. So pretty much everyone needs a will, right? A will governs your probate estate. Trust is a very powerful way of bypassing probate. It's an entity that can own things. There's lots of types of trust, but oftentimes very popular for bypassing probate, especially for real estate. But you could also use things outside the will to make things easier, because the will is great. It makes probate a lot easier, but it doesn't bypass it. So you can use things like payable on death at your bank, or transfer on death with your non-retirement investment accounts, and of course your retirement accounts all have beneficiaries. All of those pass via contract. They won't go through probate at all. And then you have things like joint accounts, which will pass via law. So there's lots of things you can do to bypass the probate process entirely. But everyone needs a will, power of attorney, medical directive. So get those. Next slide, please. And I'll go next slide. So again, where we would focus with a member would be determined ultimately what stage of life they're in. There are certain things that are universal. Hopefully I've mentioned a few of them today. Other things are going to be more specific, but we're starting out by building sustainable foundations, right, that can last you for your whole working life. And then as you get older and move into a more retirement situation, it becomes much more personalized, much more in depth, and hopefully leads to a fulfilling retirement that you always wanted. And I think that's it. Next slide. So yeah, you can use this QR code to connect with an appointment, or get an appointment with an advisor. And then the last slide, I think we'll start the panel discussion. If you want to come up. I guess what we'll do is just pass this around. Sorry. You got space? Any questions?
You want me to introduce myself?
Oh yeah,
first, I
yeah,
guess?
please. Look at the process.
I don't know if we can get everybody. Want to try to get everybody onto that one, or
If you can, I don't know.
Yeah.
there you are.
Now we can move it around.
I'll tell you what. I'll let you introduce yourself, Jessica,
That's fine.
and then we'll position it down.
Great. Hi, everybody. It's great to have an opportunity to speak with you today. My name is Jessica Harrison. I'm an assistant vice president of branch operations with Navy Federal Credit Union. So happy to also answer any questions that you may have that don't necessarily fall within the wealth management aspect of things. And yeah, with that, I think we can open the floor to any questions that we may have. Should we start with in the room, perhaps?
All right. Scrunch just well, I'm gonna put it down. So get now, how we doing?
I'll lean in if I'm not. Uh-oh.
Just take hands.
Yep.
Okay.
There we go. All right.
Yeah. So again, any questions in the room?
Yes, ma'am.
All right. So,
Lila.
so you mentioned in the presentation retirement, separating from the military, different options. You mentioned only the TSP to the Roth IRA, coming it out, that if you pull it out, you pay taxes, things like that. So for someone, in my case, I just recently retired. I'm planning on taking like 6 months off before I move into another career. Would love to know some options on what to do. The idea of pulling it out. I don't know what kind of taxes that's going to be, what that would look like. IRA, I don't know about that. So just curious on from all of you, what would be your recommendations? To be honest, I paid my money quite nicely, so I probably don't have everybody and 6 months. So we'd love to know from all of you guys what your recommendations are.
Okay, thank you. That's a great question. So the question is, for those that aren't here, what about options when you're separating from the military and you have money in the TSP, and what are some things that you can do, and what would be your options? And you mentioned as one of the possible options taking a withdrawal. I usually do tell folks to be very careful about doing that, because if it's not considered a qualified withdrawal, meaning you're not of retirement age, and there are some ways around that. You don't have to always be 59 and a half, but just generally speaking, if you're not of the proper age, then you will pay. It's not considered a qualified distribution, so you're going to pay taxes on it and a penalty on top of that. So that's usually what I would consider to be the last choice of what to do with your funds. In the meantime, you're certainly welcome to just leave it there. You saw that the TSP has very low um, expenses. You saw that there on the slide I showed earlier. The other options you could think about, you did mention an IRA. If you don't have a future employer, then if you're planning on not working or maybe just working for yourself, then the 401k option, that's not going to be viable for you. But you can, put it into an IRA as well. You're going to have to be careful about the tax implications. So if you have a traditional IRA, a traditional TSP, the easiest thing is to put it into a traditional IRA. Otherwise, you're going to pay taxes on it because you haven't paid taxes on it before. So if you wanted to try to make your traditional TSP into a Roth IRA, let's say, you're going to have some constraints there, as well as some time constraints, because you have to have had your Roth open for 5 years before you could start taking money out of it. One of the new options next year, I believe, for those who have funds in the TSP is going to be that you can convert within the TSP itself from a traditional to a Roth, if you're interested in doing it right in the TSP instead of trying to move it out and do it that way. The other thing I should have mentioned is once you separate from the military, you can no longer contribute to the TSP because you're not in the uniformed services anymore. Some folks, if they go to work for the government, do have an option to contribute to the TSP. That's a different TSP account that would have to be combined later. But you can't contribute to it, but you could roll money into it. So if let's say you do go, and this is not just for you, because I know you said you may not work, but if you go out, get a job, contribute to a 401k, and then later, if you've left your TSP account open, you can later roll money back into it. That's why some folks want to keep it open, to keep their options open, because you could do the same. The only thing right now that you can't do is roll a Roth IRA back into the TSP. You have anything to add, Mike?
I would say, since you're experiencing a change in your circumstances, you heard all the options, right? Which one is best for you will depend a lot on your next stage of life, your plans. It's probably worth just talking to somebody, right? Maybe doesn't charge people for advice, right? So if you want to talk, we can talk, or talk to anybody, because there are a lot of factors to kind of sift through in your situation, and you just want to know that you're kind of doing the right thing so you can move on to your next job or whatever, and know that you're not making a mistake or something like that. But yeah, thank you. Any other questions or this room?
I want to interject here just for a moment. Second, oh, yeah. We have this question. Your services, any point of grade, possible for a member to take advantage of the services that you provide?
Okay, I can take that question. The question in the room was just around cost for using services provided by Navy Federal Credit Union. So again, as Mike was explaining earlier, we have the subsidiary of Navy Federal Investment Services. That there's no fee there. If anyone is interested in membership and you don't happen to be a member of Navy Federal Credit Union, so I'm not talking about investment services, but the credit union, there is no fee there. Just we ask for $5 that goes into their savings accounts to establish membership. And based on the group that we have here, I'm pretty sure you all would qualify for membership. Did that answer your question? Okay. Yes, sir.
Could you just speak a little bit more on what specific kinds of services that the Navy Federal Investment Services provide?
So the question was regarding the types of services that Navy Federal Investment Services provides. Yeah, I would say at the end of the day, the services Navy Federal Investment Services provides is holistic planning, financial planning. It's kind of an umbrella term. Kind of everything we talked about today would fit under that term. So it's highly individualized, right? So not everyone needs everything all the time. And so depending on who I'm sitting across from, it's really at my discretion to, see how the conversation goes and what kind of services you probably benefit from. But just to list them again, financial planning, so cash flow management, cash management, investments, obviously, insurance, I think that's pretty much estate planning is the other big one. But those are kind of the pillars of a sound plan, and it's any financial planner's job to make sure that those are all in good shape. Sir.
I have a follow-up question. Regarding estate planning, services that provide include all aspects of estate planning, and the other question is, will the person end up working with the same person from the first graduate to do all the different things that's necessary to establish estate planning portfolio for the person?
The question was on kind of the scope of services that we have for estate planning, and I think the kind of consistency across, depending on who you're working with. Yeah, so every advisor is different, so every person's going to approach things differently. But in general, most people, especially if your situation is more complex, like a retiree's would be, you need 3 people in your life usually. Right? You need a estate planning attorney, right? Because I can't write the will for you. I can't write the trust for you. I'm not an attorney. I don't know how to do that. I can tell you whether or not I think you'd be a good candidate for these things and what I might consider talking to your estate planning attorney about, but I'm not writing any documents or notarizing anything. You need a CPA or an EA for taxes, usually, and a CFP, some financial planner, okay? And those are your 3-legged stool. It's supposed to work together to make sure that your plan is in good shape. So to answer your question, yeah, you basically, it would be just a conversation. You tell me what you want to do, and I'll tell you how to do it, and the attorney will actually execute it. Other questions?
Are there any online questions?
My computer lost a thing there for me.
Oh.
No problem.
The only thing that I was going to mention during my point was the reason that we have financial planning discussion is that junior officers, when we come to the military, nobody comes to this. And the key thing to that is it's based on starting as young as you can to make as much as you can to move to the economic side. It's kind of like talking to kids. I got 5 kids, and you're talking about insurance. And I don't need insurance. I'm young, I'm healthy, I don't want today. And we have to start ingraining that. So that's why we're doing these statements now. So you can at least be exposed to that and start working the way to start making. You don't know what you don't know until you start hearing some other things and ask the right type of questions so it can set you up as you move down the path when you're talking about retirement. A lot of us, I didn't plan on staying in the military. You kick me up something 4 years and I'm out doing something else. But life happens. And we learn those kind of things. We simply have people like the panelists here come and talk to us as we develop, as we mature, and things that didn't seem important all of a sudden become important, as opposed to we just age out of it like, dang, I wish somebody had told me so I could have started doing this 10, 15, 20 years ago. now currently wheels kind of generate and start looking at that. Not just for them, let's think about some of the other families that are in the same kind of situation. They don't know where they're going. So we want you to, if not ask those questions now, think about some of those questions. And this is a journey. These are people that you can contact, and they'll leave their contact information with you today, so that you might think of something down the line and be able to pick up the phone or email them and say, hey, I was at the summit, and here are the questions that I have for you now, and I didn't have them because I didn't know what I wanted to ask or what I needed to ask. And these are people that are going to be in the toolbox when you're thinking about it and planning what's going to happen down the line. You might not plan to retire, you might plan to retire, who knows, things change. And it's good to have tools in the toolbox that you can go back to for get information and kind of push you along the journey. So this is my thing. Anyway, are there any other questions that you might have for the panelists here as we go along? Or any comments that you folks would like to make? As you look through things, you might have got something to say, oh, let's talk about this. I'm back in.
I did, while you're looking, I did just want to mention one thing, because MOA, I don't know if I said, we have over 350,000 members. So I do talk to a lot of officers, transitioning officers, active duty and retiring officers, or retired officers. And I do think that there's a lot of folks, it's much easier to accumulate wealth, although when you're young, you don't think so, but it's much easier to accumulate wealth than to figure out how to decumulate when you retire. And that's much more complicated, and it gets into a lot of the issues that Mike mentioned, and I mentioned the thing about Medicare and taxes, and all of that is very complicated. And I do think that it is important to seek out. That is the time, if no other time in your life, that you seek out a financial professional, is when you are at that point where you are ready to not be working anymore, and you need to figure out how you are going to take withdrawals from all that you've been building up over the years, and how you're going to plan and your estate and what kind of legacy you want to leave. I see a lot of folks not wanting to take that next step, and I'm just like, most financial professionals I know actually go to another financial professional to have help doing accumulation. In fact, every other, I have a CFP. I mean, because I can't look at my own stuff and be objective about it. And so I think a lot of people are reluctant to get help, but this is a very complicated stage. Some of you are young, and I see that, but I mean, and I'm not saying you don't need help along the way, but I see people at that critical age, and they're not willing to get help. But it's a complicated process, and nobody does tell you exactly how to do it. There is no exact playbook for it. So I just want to encourage folks not to feel intimidated. And, like you said, we don't know what we don't know. And everyone can use some help, because it is complicated.
Just one thing to add, Navy Federal does have a lot of resources that you can look at online. In particular, we have something called Making Sense. So that's spelled making and then CENTS. There, you're able to find ways to create a budget if you don't know where to start. There's worksheets. There's all sorts of great articles for different life events that you might be going through. There's links as well. I know we're talking a lot about wealth and how you're going to be saving for the future. But if you're having a situation right this very minute where you're having trouble paying the bills, we can also connect you through Making Sense to a personal financial management individual. Again, there's no charge for that. And they'll just help you prioritize bills and things too. So I know everybody's in a different situation. So Making Sense might be a good opportunity. I use that to also check my credit score. So another benefit to that too. Any other questions? Do we know if we have anything online, or?
I have not seen any. Matter of fact, we're about 3 to 5 minutes behind the stream because we're buffering every now and then.
Okay.
So they I hadn't seen any questions up to that time. They put a thing in it that they can't answer questions. So what we might end up doing is just answering the questions through the chat.
Okay.
Later on, once the questions come through. Again, that's that learning curve, not realizing that sometimes it buffers. And that's why we would end up.
Right. Yeah.
And then we have Marvin coming and say, yeah, that's going to happen. And then catch up, just keep going. And that's what we're doing. So we'll probably end up contacting you guys sometime later on the day. I'm sure they're going to stay for lunch or not. But we'll probably answer those questions from the chat at a time to cover that question in the delay. But it's sure I want to thank our panelists here for coming out and spending their time with us to give us the information that much needed. Thank you, ma'am.
Thank you.
Thank you, sir.
Thank you, sir.
And thank you again, ma'am.
Thank you.
Absolutely. And I have to say that mindless plug here that when I first joined the Navy and AOC, I ended up going to Navy Federal and ended up becoming a member board a little bit later on after I got in and found out because they provide services that all of us need at one time or another. Maybe not necessarily right now today, but as long as you're in that group, you can pick up the phone and say, hey, tell me about this, or I heard it. This was fun. And give us a hand. And so we're happy to have these organizations be a part of us in a way to give us those points of wisdom and help us out with some of those things that we're doing. So if you don't have any more questions, the session was going to go to 11:30 and the lecture starts at 12. So we'll have a little bit of time now to kind of readjust and maybe get a chance to meet and talk to folks and be ready to go at about 12:45 in the Virginia moves. We'll be where this morning for the